The LBMA and the COMEX were exchanges that were designed to offset risk. They've turned into much more than that. On the LBMA right now, you have between 4 and 6 billion ounces short in silver, where these banks, these commercial banks, which I believe are facing an existential threat, are trading up to 2.9 billion with a B ounces of silver per day. That's 3.5 times annual global mine supply. Now the numbers say 290 million per day. What I guess I'm simply saying is that I don't think we're in the first inning of the gold bull market. But all things considered, the environment today points to gold having a good deal of room to run before we hit the later stages of this cycle.
The silver market, often overlooked as gold's counterpart, is currently on the brink of a significant short squeeze that could reshape the financial landscape. This situation goes beyond simple market manipulation. It reflects a combination of structural weaknesses, critical industrial demand, and increasing investor awareness of the potential for change. Andy Schectman highlights that the narrative of silver price suppression by major financial institutions is backed by documented facts rather than speculation. For years, a small group of powerful banks maintained substantial short positions in silver, effectively acting as a cartel to control prices. The market stability is precarious, with billions of ounces short and trading volumes vastly exceeding the annual global supply. The prevalence of naked short positions indicates a reliance on paper contracts rather than physical metal, posing a risk of a sharp price surge if there is a sudden demand for physical delivery, an event that could quickly overwhelm available supplies. Recent adjustments in Federal Reserve policy, particularly the decision to lower interest rates while long-term rates continue to rise, underscore the challenges faced by central banks. These conditions may lead to prolonged inflation, prompting investors to seek safe haven assets. Additionally, recent bank failures expose vulnerabilities within the financial system. Andy points out that the growing awareness of bail-in policies may diminish public confidence in traditional banks, leading more investors to turn to precious metals as a protective measure against economic instability. Investor behavior is pivotal in shaping the dynamics of the precious metals market. Many financial advisors recommend minimal allocations to gold and silver, indicating a significant gap in mainstream investment strategies. However, as economic risks become more evident, average investors may begin to see the value of precious metals, potentially leading to a surge in buying activity. This shift could greatly impact market demand and pricing, especially if more individuals decide to accumulate these assets. Now, we present the clips of Andy Schectman's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
As far as what Alistair said, he's right. It's not that gold goes up, it's at the currency that we measure gold in, the fluctuations of those currencies in particular. In the dollar, I did an interview the other day with a gentleman who said to me, Andy, money creation, which is really the definition of inflation from a classical sense. It's always a monetary event. It's an increase in inflation of the money supply is inflation. Price inflation is a different thing. But when we talk about money creation averaging 7%, I would argue that's a little light, but let's just play that out. He said, for the last decade, it's at 7%. Well, ironically, when we apply the law of 70 seconds to that, which says you take your interest rate and you divide it into 72, and it tells you how long before your principal doubles. So 10 years ago, the dollar was worth twice what it is today by that standard, by money creation alone, by inflation, or pretty darn close to it. And gold was $1,200 an ounce then. So did gold nearly double, or actually just over double, rather? Or did the dollar lose half of its value? I think that's the important thing here, is that gold is the barometer by which we measure the health of the system. And I think the dollar has a long way to go in terms of where it ultimately ends up. It should be much less than it is. The justification for a dollar as strong as it is right now is ludicrous. I mean, we're right at that 120-ish% debt to GDP level, where back when I started in this industry, anything over 100% was a banana republic. And, then you throw into it all the things that I talked about in the previous question, centering around, election integrity and judicial system and all of these things. And you wonder, I mean, isn't that what people used to say was a banana republic? Election interference and debt well over 100% debt to GDP. So we'll sidestep all of that for a moment, but this is one of the reasons why I think you're seeing such a strong drive to gold. I mean, forget about the fact that going back for 25 years, gold has doubled the performance of the 10-year Treasury and has beat the performance of the S&P 500 with dividends reinvested, which has averaged about 9.6%, with gold right around 9.9% for 25 years on average. So its performance is better, but these are assets that have plenty of counterparty risk, as we see, where gold has none. To Steve's point, I know, Steve, I look like I have such a baby face, but I've actually been doing this for 35 years. And I read that book by Roy Jastrom, The Golden Sexton. And I remember a long time ago something sticking with me in that book. And that was, if I remember correctly, the overwhelming theme that, yes, gold does very well in inflation, but actually does better in a deflationary environment, as it is an asset that has no counterparty liability. And so kind of Richard Russell's old saying, he or she who loses least wins, and having an asset like that maintains no counterparty liability, doesn't have the systemic risk built into it, to me, makes it even more valuable than it is in dollar terms. And this is one of the reasons you're seeing the BRICS and all of these countries in the global south accumulate gold, because of the counterparty risk of holding treasuries and because of the irresponsibility in our fiscal policy, which is very easy to see, and you can understand why these countries are doing what they can to protect themselves. Also, to Steve's point, talking about the strength of gold, even in the face of positive real yield, a strong dollar, and ETF outflows over the last 2 years that have fallen at a 45-degree angle. Now, albeit they are starting to turn up a little bit right now, the large move that we've seen in gold, it was void of American participation. And if you would ask someone who is mainstream oriented and say, what would gold do in an environment of a strong dollar, positive real yield, and massive outflows out of the ETFs, virtually, signaling no participation by the American public, one would think that the price would collapse.
Gold prices have surged to new record highs this week, driven by uncertainty surrounding the upcoming election and the escalating U.S. national debt. Year to date, gold futures have increased by over 32% and more than 38% in the past year, consistently setting new all-time highs. Investors are flocking to gold as a safe haven amid geopolitical risks, including ongoing conflicts in the Middle East and Ukraine. The uncertainty about U.S. economic policy post-election, coupled with the Federal Reserve's rate-cutting plans and the long-term implications of rising national debt, has further fueled interest in gold. Historically, gold has outperformed other assets, such as the 10-year Treasury and the S&P 500, particularly during economic instability. Its unique characteristic of having no counterparty risk makes it an attractive investment compared to traditional assets, especially as countries seek to reduce their exposure to U.S. Treasuries. As Alasdair MacLeod points out, the key factor isn't just the increase in gold prices, but how currency fluctuations, particularly those of the dollar, impact its value. In a recent discussion, Andy Schectman highlighted that money creation, often linked to inflation, has averaged around 7% over the past decade. With gold priced at around $1,200 an ounce a decade ago, its price has effectively doubled, underscoring its function as a barometer for the monetary system's health. Andy contends that the dollar's current strength is unjustifiable, especially considering the unsustainable debt-to-GDP ratio that has surpassed 120%.
And in my opinion, and maybe I'm in a minority on this, but I've been very vocal on it, the LBMA and the COMEX were exchanges that were designed to offset risk. They've turned into much more than that. On the LBMA right now, you have between 4 and 6 billion ounces short in silver, where these banks, these commercial banks, which I believe are facing an existential threat, are trading up to 2.9 billion with a B ounces of silver per day. That's 3.5 times annual global mine supply. Now the numbers say 290 million per day, but they say those numbers are up to 10 times understated due to they only post the final settlement numbers, not all of the ins and outs and ups and downs that the trades that they take to get to those final settlement numbers. They have 800 million ounces of silver on the LBMA, approximately, of which 500 million belongs to the ETFs. They have a float of 300 million ounces, and they're trading that entire float every single day. And if you look at the actual trades, it's 10 times that amount every day, double the annual global mine supply in gold. But most of these trades, 90+% of them, are naked short on paper. On COMEX, you have 8 banks, 8, that maintain the largest concentrated short position in any commodity ever traded ever on COMEX in silver, about 700 to 800 million ounces short, as dumb as a mud wall, when the rest of the world is accumulating commodities because of the things I just mentioned, the lack of trust, the inflation, the realization that we can't normalize our balance sheet, that by pivoting proves that when they are 60% away from their target of 2%. That's not signaling victory over inflation. It's waving the white flag. And I think you can see that by the back end of the market throwing up and selling off, and the interest rates going up by 60 basis points 2 weeks after they lowered the front end down by 50. That's the back end's way of saying, no, you're trapped and that's not going to happen. So what I guess I'm simply saying is that I don't think we're in the first inning of the gold bull market, but all things considered, the environment today points to gold having a good deal of room to run before we hit the later stages of this cycle, because all of this movement has been void of American participation. As my good friend Rick Rule often says, you take Joe and Jane six-pack all the way up to the Harvard Endowment Fund, and what you see is a 1/2% allocation to precious metals. A 5% allocation is a tenfold increase. And I think you see bank failures like we saw in Lindsay, Oklahoma. Most people don't even know what a bank bail-in is. And we just saw the first one and not a word about it. You know, we bailed out Silicon and Signature with hundreds of millions in uninsured deposits. But the 7 million in uninsured deposits in Lindsay, Oklahoma, 3.5 million say bye-bye to. It ain't coming back. And that's a trial balloon. Wait until there is something, whether it be the commercial real estate eroding to such a point that we start to see real bank failures with real uninsured deposits bailed in as part of the Dodd-Frank Act legislation. And there's an awakening when people say, my God, why have I not listened to Alistair McLeod all of these years? Why have I not put some money into precious metals? And when that happens, bang, like that, you ignite the realization that there is no bull market like a metals bull market. And in that environment, the people who have made big profits in dollars, they're not going back into dollars. Are you kidding me? I don't care what kind of profit it is. So the secondary market's gone. And the fragility of this market in an asset that is, becoming harder and harder and harder to get, I think becomes stark.
Gold has confirmed a significant bull market breakout in 2024, moving beyond the $2,000 mark. Analysts project that gold could reach between $3,000 and $5,000 by 2030. As the Federal Reserve meeting and the upcoming election approach next week, the silver market is poised for potential volatility. If the Fed implements a rate cut, silver may gain momentum, testing critical resistance levels at $34.87 and $35.40, particularly if the dollar and yields weaken. Conversely, if the Fed refrains from further cuts or signals a cautious approach to monetary policy, silver could face headwinds, especially if Treasury yields rise and the dollar strengthens. Silver could decline to around $30.44 to $30.12 if selling pressure persists. Please share your thoughts on Andy's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.